What's going on? Welcome to my channel. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income using covered call ETFs. Of course, subject to change. I'm using covered call ETFs to reach $120,000 a year, but once I reach that goal, hey, I'm open to all options to pivot. Of course, I am not selling anything, so let me know in the comment section below where I should pivot. I am open to every single option available. All right, projected annual dividend / options income is about $82,000 a year, 6.8K a month, 1.5K a week, and about $226 a day. Hourly is about $9.42. So hopefully by the end of 2026, maybe I can put it to like $10.50, $11. I'm hoping for it, so that would be amazing. All right, this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. Now with that out the way, let's get started on one of my favorite fund from Amplify. If you are new, I'm one of Amplified fanboys along with Goldman Sachs and of course NEOS, right? Because who isn't a fanboy of NEOS, right? So this is kind of my trifecta right now, these three. And I'm going to be talking about the ticker symbol NDIV. Is it the 10% yield trap or treasure? We're going to be looking at a strategic analysis of it, NDIV versus the world, right? So we're going to do a February 2026 deep dive because NDVI has changed a little bit, and we're going to be looking at how they changed and why or why not if it belonged in your portfolio. All right, let's look at the hook. Are we buying an income engine or a growth trap? All right, so why energy is exploding in 2026, right? So I am seeing a massive shift. As you guys know, I made a video on SCHD, so this kind of correlates, right? This is the energy supercycle. It isn't just hype, it is structural. So what do I mean? I think it is broken down into these three pillars driving my thesis right now. One, of course, where have you been? Even if you haven't been investing, right? AI and the data centers, right? It is the base load renaissance here. Hyperscale AI needs power and lots of it. So this directly benefits my natural gas producers and grid operators. Number two is reshoring, right? So under this current administration, right, we are at least trying to bring back manufacturing home. That means we need more copper, lithium, and steel, okay? Industrial materials are back in style, and geopolitics, right? Tensions are high right now. That reintroduces a risk premium to oil. Volatility is up, which is actually good for my option premiums. And if you haven't noticed, even if you don't invest or not into politics or into whatever, or even if you don't watch the news, you have to know what's going on with the United States and Venezuela, right? All right, so what is the context here? What I'm trying to say is high demand plus high volatility equals the perfect storm for us income investors, okay? For those who are new, all right, we sell and we buy the fear. That's how we are collecting our cover call premiums. All right, so what is NDIV's great rebrand? They have rebranded, okay? They did that February 3rd, 2026. So mark this on your calendar, right? NDIV has changed the game. It used to be natural resource dividend income ETF, boring, vanilla, white, plain, right? Now it is the amplified energy and natural resource covered call ETFs. But why the change? Well, because 3 to 4% dividends from Exxon aren't enough anymore, right? I need to compete with the 12% derivative yields. So this isn't just some random rebrand, right? It's a completely new risk return profile. The event of this is that, well, we should ignore all data prior to February 2026. It is a completely different fund. All right, so let's look at the 3-part master plan. All right, so if I want to buy NDVI, right, it is actually on my watch list. Right, so I am explicitly signing up for these 3 goals. Number 1 is high target income. Right off the bat, if you're not aiming for this, just all right, this is not for you, right? But if you are, I'm aiming for 10% or greater annually. All right, this is bold. This puts me in the ultra high yield arena. Yes, I do know there are the 30, 40, 50, 50, 60, 70, 80, 90, 100, 110% from others. But realistically, anything above 5, 6% is considered high yield, right? And then anything at double digits, it's ultra high yield. I'm going to get that a lot in the comment section, but it is what it is. This is the truth, all right? And for those who are new, I like to stay within the 8 to 15% range. Why? Because I believe those are much more structural, sustainable, reliable over the course of 30 plus years, and very, very easy to do. They're aiming for anywhere from 0.8 to 1% per month. If you're a hedge fund and you can't do that per 1% per month, well, you don't deserve to be here, right? All right. And number 2, capital appreciation, right? So unlike some fund that cap everything, I want to balance income with growth. And so I don't want to be writing calls on 100% of the portfolio, hopefully. And it seems like Amplify is really setting themselves up. I personally think Amplify is setting themselves up to be like that, both growth and income with very modest yield, right? Very reliable, sustainable yield. So Amplify is really starting to capture my attention in that aspect. And then number 3, you're buying this for the inflation hedge, right? So I'm buying a basket of natural resources to protect my purchasing power when cash erodes. The goal here, I want bond-like income, right? Very steady, very reliable, right? With equity-like inflation protection. So every other month to every other 6 months, a year, it does grow because, things get more expensive, cash erode, right? All right, so it's more than just oil wells, right? So most energy funds just buy Exxon or Chevron and call it a day. NDIV is different. I'm getting exposure to roughly 54 securities across the full resource spectrum. Energy, oil majors like E&P, consumable fields. This plays the AI energy demand thesis. Materials, metals and mining. This is my play on electrification, right? Copper and lithium. And agriculture, food and fertilizer. This is my defensive layer. People got to eat regardless of the economy. People got to need medicine, right? People need a place to live, right? These are the assets. Diversification away from single stock oil risk. All right, so how do I print this 10% yield, right? We got to look underneath the engine. What is underneath the hood? So I'm going to look at this like a twin turbo engine. To hit the 10% target, I need 2 things working together. I think this is how the NDIV is playing this. Engine number 1 is the organic yield, about 4%, right? So this is the base layer. Since 2018, energy dividends have grown 50%. I'm collecting cold hard cash from profitable companies. Engine number 2 is the volatility part. This is where the 6% comes from. So to get the total of 10% yield they're claiming. So this is the turbo part, right? I sell call options. Energy stocks are volatile, high IV. That means option premiums are expensive, right? So I sell them to generate that extra 6% income, right? But the catch here is by selling options, I do cap my upside if the stock does rally past my strike price, right? So that's the mechanics behind it, right? I'm monetizing volatility to bridge the gap. You get the 4% from the organic, from the underlying you're holding, and then the 6% you're writing the calls here. All right, this is boring but important specs, okay? I always talk about the good, the bad, the ugly. I don't know how you want to place this, but the good is 0.59% expense ratio. I put that in the middle tier, right? Cheaper than MLPD, but more expensive than XEL. Assets under management is right now 18.5 million. This is tiny. I talk about this a lot, right? So this liquidity, this brings liquidity risk. I'll talk about that later. If you're new, I do talk about a lot. I'm not a hater of tiny funds, but you do have to understand that typically funds with 100 million assets under management or less does put you at a greater risk, does make it harder for the fund managers to make profit because their spreads are larger. The bid-ask pricing is bigger. So when that happens, when they're playing, they're not like us where we're playing in the hundreds or thousands. They're playing in the millions to billions, right? So they do have to pay that extra 1 to 3 cents per ask that they buy. So, right, and then the good is monthly for us income investors, right? It's great for my cash flow bills. I need it. But what about the tax form? It's a 1099, no K1 forms, simpler tax time. I love it. Amazing. Right? The structure is that it's small, nimble, and monthly, but you have to watch that liquidity. That is the ugly in this specs right here. So just be careful of that. I want to give you that warning. That is what I'm looking at. If they can grow it, I'm looking at it for the next 3 to 6 months to see how much it grows. Right? Do they double, triple? Do they stay the same, stay flat? Right? I want to know how they're growing right now. All right, competitor number 1. Let's look at MLPD. The yield trap, we don't know. Let's look at it. Let's go. Global X MLPD is the main rival, right? It is a synthetic midstream play. Here's the problem. It's the at the money trap. I talk about this a lot, right? You have to be aware of that. MLPD writes at the money calls. Why does this matter? Well, the pro is it does max premium, right? The yields does hit 11 to 13%. The cons, I constantly talk about this, is that it's zero room for growth. My upside is completely capped at the current price every single month. If the market rips higher or just goes beyond, right, MLPD will stay flat. If the market drops, MLPD drops. So what does this do? This does lead to NAV erosion, okay? This is the warning here. MLPD is for income, strictly income only. Do not expect growth. Competitor number 2, let's look at SPYI. This is the gold standard, right? NEOS SPYI is the benchmark. So I need to stack it up against the benchmark. So how does NDIV stack up against the king? Right? So SPYI strategy uses call spread. It sells options, but further out the money options. So this lets it capture some upside in the rallies. The yield is about 12.2%. And on top of that, it has the tax advantage of Section 1256. SPYI uses index options, so 60% of its income is taxed at lower long-term rates. Right? NDIV is mostly, I'm going to say right now, we don't know yet, mostly ordinary income. All right, but what is the strategic fit here? Well, NDIV does diversify SPYI, right? SPYI is the broad market. NDVI is commodities. They work well together. This is where it's like, you know what? They are two very different things for two very different products for two very different strategies. Okay, so this is the benchmark. SPYI is more tax efficient, but NDIV offers inflation protection. All right, let's look at its traditional pairs, right? Don't let taxes eat gains. If I hate cover calls capping my upside, I will look at these two. Let's look at AMLP. The structure is a C Corp. The catch, you do pay 21% corporate tax, right? It is a performance drag. And this is best for tax deferred income, okay? And let's look at ENFR. And the structure is RIC. It's an ETF. Right, the catch is it is a lower yield at 4.8%. It is best for total growth. My take here is that ENFR is historically superior for total return because it doesn't pay that corporate tax. It also captured the AI boom fully. Right, so when we're looking at structure here, structure matters. Avoid C Corp if you want peer growth. Right, is it fake yield or is it real yield? Right, let's look at the scoreboard here. Right, but remember, highest yield doesn't always mean the best. Right, so we're looking at SPYI with very tax efficient 12.2% MLPD at the money called. All right, that's their strategy. They have, I'm going to say, very high erosion risk. Their yield of 12 to 13%, and then NDIV is targeted, right, managed target of about 10%, and then ENFR is funded, right, peer growth at 4.8%. This is a scoreboard, right? ENFR is the most sustainable, right? MLPD is the most dangerous, in my opinion. Okay, what does Uncle Sam take? Because we always got to worry about that. When you are playing your strategy, you always got to worry about what Uncle Sam will take. Because it's not how much you make, it's how much you keep. All right, so if I hold these in a taxable account, this ranking is critical. I'm going to put ENFR, qualified dividends, max 20%, best for growth. SPYI is section 1256, 60-40 split, best for high income, right? So if you're trying to be a high income earner like myself, well, this is where you got to start looking at. AMLP is return of capital, good for deferral, but lower cost basis. And at the moment, I believe NDIV is ordinary income, least efficient. I do pay a marginal tax rate up to 37%. This is where you have to worry about your tax bill, right? Keep NDIV in your IRA if you can. Or, of course, they can change their strategy. I'm just saying that's if you have it, if you're going down that road. It's okay with a taxable account because, you know, at the end of the day, if you're using this for income to live off of, this is where you should be putting it. All right. But what happens if scenario A, an AI boom does happen? Oil goes to 100%, energy rips, right? The winner here would be ENFR because it captures 100% of the upside. The loser, I'm going to say MLPD. You get the most premiums, I guess, but you're capped at 0. NDIV, well, this is the middle ground, right? You capture some. What about scenario B in a recession? Oil crashes to $50. The winner here would be SPYI NDIV because it has high premiums to offset the drop. And the loser would be, of course, ENFR, which feels the full crash because it is pure growth. Right? Reality is that there is no free lunch. You do have to choose your risk, and you do have to build your NDIV around other, pretty much other cores to hedge against it. All right, hidden risk number 1 is that execution is everything. What do I mean by that? Well, the headline yield is 10%, but the silent alpha comes from how they trade, right? Moneyness discipline. If NDIV writes at the money to chase yield, they become a growth suppressor, right? I need them to write out of the money, and the overwrite is unknown. Or are they overwriting 30%? Or 100% of portfolio. If it's 100%, I effectively own a bond with equity downside, right? So the execution strategy design beats headline yield every time. All right, so I'm gonna keep an eye on it. I don't have to rush anything right now. If their strategy pulls out, right, I also worry about their assets under management. So that's something I do look at. And right now it's on the watch list, and I will be keeping an eye on it, especially how the environment is with oil, energy, and everything else. All right, hidden risk number 2, the volatility trap, right? NDIV does need volatility to survive. Of course, it is a cover called ETF, right? But what happens during a volatility crush, right? Then this is the nightmare scenario where energy prices rise slowly, which is the bull market, right? But volatility the OVX collapses, right? The result is that premium shrinks, and to hit the 10% target, NDIV is forced to write calls closer to money, right? Aggressively capping my upside right as the market rallies. So the failure mode that could happen is that volatility compression plus rising prices equals worst case for cover calls. Hidden risk number 3. Of course, I got to mention this and talk about it a little bit more, right? Liquidity and correlation. This is the liquidity drag, right? NDIV only has about $20 million in assets. SPYI has billions. So as a single stock energy option, have wide spreads, right? So this creates execution slippage. What do I mean? Every trade costs me a little bit more than it should. Those pennies stacks up when you're playing in the millions, right? So this is the correlation illusion. I think I'm diversified, but in a liquidity crash, energy goes to 1-for-1 with the market. NDIV diverses my drivers, but it is not a safe haven during a panic, right? And so you do have to watch out for this illusion. Don't mistake different sectors for safety. All right, so what is the identity crisis, right? What am I buying, right? We got to stop the confusion. Here is exactly what NDIV is and isn't. In my opinion, it is not a long-term compounder. It is not a commodity beta proxy, and it is not a replacement for Chevron and Exxon shares. But what it is a cash flow transformer, a volatility monetization slave, and a regime dependent tool. So you're saying, why is it not a long-term compounder? Because of what it is, right? Is a regime-dependent tool. When oil does flip, right, it can completely go in a reversal, and you're not going to be able to compound as much as you need. It is what it's going to do best is a slight growth plus income, but it's very moderate, right? It's very modest and it's very cycle dependent. Right? This is a definition of use the tool for what it's built for. All right, this is my ultimate buying guide. So which one fits my portfolio? Here's my little cheat sheet, right? Choose ENFR if your goal is total wealth, right? If you're pure growth, right, income doesn't matter. You want to capture the AI energy build out fully. Choose SPYI if you're the tax efficient income investor, right? From the board market S&P 500. All you care is about that tax efficiency. Choose MLPL if you only need to max cash flow now and don't care about capital erosion, right? Choose NDIV if you need an inflation hedge with a 10% yield to diversify the income stack, right? This is the thesis here is mix and match based on your goals, right? So I put NDIV through the gauntlet, okay? I didn't just read the fact sheet. This is my simulation scenario of a real world stress test, and here's the battle plan. The shield, I'm gonna say, if you wanted to build something, a scenario here is 40% SPYI as your core, 25% as your growth engine with ENFR, and 15% NDIV as your tactical yield. And you might have 20% cash as a safety buffer to invest and buy the dip, or just spread out in other sectors. This is just an example, right? This is the shield type of take here. And what is the attack? And these are the stressors. Attack number 1 is the volatility crush, right? A 40% drop in income. Attack number 2 is the energy crash, where it's a 20% drop in price. Attack number 3 is the rebalance trap, right? Methodology is that we don't guess, we calculate, and you kind of have to go and hedge against all of these 3 type of attacks that could hit your portfolio. Stress test A is the income dry up scenario. I talk about it. The volatility collapse, NDIV's option premiums evaporate. This is the shock. NDIV's yield crashes from 10 now down to 6%. There's a 40% drop in NDIV's payout. The portfolio impact, well, my total portfolio income drops, right, 0.60%. Only 60 basis point is lost. By keeping NDIV at 15%, you insulate your lifestyle from risk. All right, the result here is sizing does matter. 15%, I would say, is probably the sweet spot. So, stress test B, right? This is the energy crash. Scenario here is that if oil drops 20%, the market does panic. You can look at it here. ENFR, the pure growth, drops 20%, right? NDIV drops 15%, SPYI drops 8%. Cash, of course, you're holding, right? So the impact here is that your total portfolio drawdown could be around a 10%, 11% drop versus a total average of 20% sector crash. This is the great protection here, right? We cut the crash risk in half. All right, let's talk about the rebalancing trap. This is the most dangerous moment, is the recovery. In the V-shape problem here is that market crashes, ENFR falls hard, NDIV falls less. The market rallies back, and ENFR rockets up, NDIV is capped. This is the mistake here, is that if you rebalance into NDIV during the rally, right, you're basically selling the winner, which is ENFR, to buy the capped loser. Of course, everything comes into play if you don't worry about too much of growth, or if you don't care about growth. This rebalance is okay too. This is where you're going, you know what, I'm just going to maximize my income. I like it, right? But this is a strategic fix. Suspense rebalancing in a sharp recover, and if you're into that growth, let the growth run. All right, so the strategy here is don't blindly rebalance into a capped asset. Understand, right? It's different from other like SPYI, where it's call spreads, where you can actually get that nice boost. My final verdict, well, NDIV is the middle way, right? It does avoid the tax drag of AMLP and the aggressive caps of MLPD. For pure growth, you know what? You don't care about the income. ENFR is your play. For the core income, this is where you build around SPYI. And of course, you have the nice inflation income of NDIV, right? Optimal strategy is you pair the growth with income for a complete energy stack. That is the end game. Right? I myself I'm trying to build an all-weather income stack. And if you like this video, smash that like button, subscribe for more no nonsense ETF analysis. That's what I try to do. I'll give you the good, the bad, the ugly, the beautiful, everything all around. It doesn't matter if I don't hold it on my watch list. I give you the no BS analysis of my thoughts. All right, there's my call to action. See you guys in the next videos. Please give me a like, subscribe, and leave a comment. I always try to read everything. I do my best. And if I miss it, I don't reply. I at least seen it, and I apologize. I love you all. Thanks for watching. Stay tuned. Catch you guys on the next.